if I told you, you and I are going to go into business for the next 20 years, you have to save all the money, do all the work, and then when we go to sell it, you got to give me 1/3 of it. Now, would you do that? Okay, well, that's exactly what we did with our IRAs and 401ks. Our government is currently $36 trillion in debt. The interest that we're paying on this is almost now $1 trillion.
Wow.
How are we going to pay for that in the future? When the market went down and your $100,000 in your 401k went down 70 to 70,000, the LIRP, the LIRP, didn't lose anything. It is actually outperforms that because it never takes the downside, because you're never really invested in the market.
Hey everyone, this is Sudev here and welcome to the podcast. Today I have a very, very important guest, Ronnie Gerson. He's been a friend for quite many years and he's been coming to Business Club. We also had a similar podcast that we recorded a few weeks ago and that was about him. But today we're going to discuss the power of zero. Now, the zero, as I know it, was invented by Aryabhatta, an Indian astrologer. But today we're going to talk a little bit about zero taxation, and that's going to be a very interesting topic, especially when it comes to post-retirement savings and things like that. So he will go in depth into the not only the principles of the book, but also into the practical aspect of insurance and things like that. So do watch out. It's going to be a very interesting topic, and I'm excited for you to listen from him. So thank you, and look forward to having a great talk. Hey, Ronnie, welcome back.
Hey, man, I'm glad to be back. Thank you for having me.
Pleasure. So, we're going to talk a little bit about the power of zero that you were talking about. So before that, I just a level set, I want to ask you a couple of questions.
Sure.
So, so tell us a little bit about yourself and how did you get into the financial industry and what inspired for you to focus on the tax-free retirement strategies?
Okay. Well, first of all, I got into the financial services industry like in 1982.
Oh, wow.
My daughter, I make this joke all the time, thinks I financed the pyramid. So, but I have been in the financial, and somebody just came and said, Ronnie, you're really good with numbers. I think you'd be good at this. And he was half right. Okay. I am good with numbers, but there was a lot more to it than just that. One of the things that brought me to where I'm at with the power of zero is kind of like a couple of years ago, I actually got to meet and hear the man who wrote this book at a conference in Las Vegas. And I had, we call it an epiphany sometimes. And I really had one. And I realized that, and I hate to use the word lie to, so I'm just going to say we have been misled on how we should plan for our retirement and how we should save for it. And when you look at the history of the 401k and IRAs, and everybody thought it was such a great idea, it really might have been at that particular moment in time. But as it evolved, it really became something very different, which was a way for major corporations to no longer have pension funds.
Right.
Okay. It got them out of the pension fund business. So I wished that I had known about this 20 years ago. I really do. It would have changed the way I think about things and how I did things. And what we have now is really trillions of dollars, I believe, in this system. People have a lot of money.
Trillions.
Yeah. Well, think about it. All of the assets that people have put into 401k are in the T word. Okay. There are trillions of dollars in this. Now, what the exact number is, I can't tell you, but I can tell you there's a lot of money in it. And what we don't understand is that when we go into retirement, what is it actually really going to cost us? And that's really what I want to try and convey to people. It's kind of like it's become a mission for me to try and educate people on it. And sometimes I have to be careful because I don't want to overemphasize anything, but it's really important for people to understand what they have. What do you have, and where do you want to be when you retire?
Got it. So David McKnight actually argues that
yes,
both 401k and the IRAs are retirement traps.
Right.
Can you kind of break that down for us?
Well, I think that's a really good way of saying that they are tax traps. And one of my favorite thing is to say to you is this, Sudev, if I told you, you and I are going to go into business for the next 20 years, you have to save all the money, do all the work. And then when we go to sell it, you got to give me 1/3 of it. Now, would you do that?
No.
Okay. Well, that's exactly what we did with our IRAs and 401ks.
Okay.
Okay. That's exactly the deal you made with the IRS
Right.
to get into these programs. And think about it. Okay. I have a client of mine, and he's one of the lucky ones. He has a lot of money in his IRA. His 401k. It's like $1.2 million. And when I told him, I said, by the time you're 65, you probably have maybe 2 million. And you're going to pay 800,000 of that back to the government.
Wow.
Okay. Over a period of time, you're going to pay that much money back to the government out of that $2 million because of his tax bracket that he will be in at that time. So, that's a big example of it, but you can scale it down to whatever you want to, whatever you have.
So many people believe that the tax deferred accounts are the best way to save for the retirement. What's the catch?
Well, the catch is this. I think you can put up to $20,000 a year.
Into the tax deferred?
Into a 401k. There are caps on it.
Okay,
401k. And even IRAs. They're all tax capped. They all have a cap on them. And depending on your tax bracket, let's say if you do put 20,000 in and your tax bracket, say 30%, well, what's 30% of $20,000? Okay, you save about $6,000 in taxes that you would have paid. Okay, so you translate that into the future. That money that you put in there, hopefully will be. And if you extrapolate over a 20-year period, let's just say you have that same 200,000, and ultimately you'll pay back in that same tax bracket. How much of 200,000? 60,000.
Right.
Okay. So what was that trade that you just made? And so you'd have to really contemplate it on that kind of level. I'm going to share you a story about this because it's one of my favorite things to talk about. And I'm not going to use the guy's name, but he's a very famous coach who was at a school and they offered him $7 million a year.
Got it.
Okay. And his financial people, and they were brilliant, said, no, I want you to pay us $5 million a year. And we want you to loan me the other $2 million. And they put this into this tax deferred LIRP that we're going to talk about, life insurance retirement program, for 7 years. He funded it for $14 million, never paid any taxes on it. When he turns 67, he will be able to take $2 million a year, tax-free till age 90.
A year.
Tax-free till age 90 through the program where you borrow the money out of the program. You borrow the money. You don't withdraw it. You borrow it. So he never paid 14 million. He'll get 44 million in tax-free income. When he dies, his family will get 50 or so, and he'll pay back 14 million to the university.
Wow. That's the life insurance retirement plan?
Yes, that's the LIRP that we talk about in this book. And I like sharing that story because, people say, well, I'm not in that bracket, but Sudev, you have a business, right?
Yep.
Okay. And you can use this same program to fund one of these policies every month, and it's tax, and take it off on your taxes. And you can do the same thing on whatever scale you want. And I don't know, how old are you, Sudev? Do you don't mind me asking?
49.
You're 49.
Mm-hmm.
So at age 65 or 67, whenever you plan to retire, whatever your retirement date, you will have saved all this money tax-free, and you'll be able to re-access it tax-free.
Wow.
So that's how it scales down. And I'll let you get back to the
questions.
Yes.
So the tax rates are historically low right now, right? So what happens if they go up in the future?
Well, first of all, that's always the big question is whether taxes are going to go up. They are historically low right now. Based off the history of taxes, you realize that we've actually had tax rates at 90% 90%.
90.
Yes, back in the 40s and 50s, we actually had a 90% tax rate. Now, the question is when did that kick in? Well, in the 50s, it was like $500,000 a year. If you translated it in today's money, you'd have to make almost 900,000. But there was a very famous president who was an actor named Ronald Reagan, who only made 2 movies a year because he said after that, I'm not paying the government back 90% of my money. That's all he did, you know? And so when you look at the history of taxes, yes, they are historically low, but what has happened is the thresholds have come down to hit that. So for you to hit that top tax rate, which is around 36 to 39% right now, you have to, if family of 4 was like $430,000. So the thresholds are different. So yes, they are historically low, but you hit the threshold so quicker.
Got it. So how does it impact for someone who has got their bulk of the savings in the tax deferred accounts?
Well, here's the issue is this. And what you have to do is sit down and ask yourself, what is your current income and where do you want to retire at? Okay. Now I hear this word, some people say you should be able to retire at 80% of whatever you're currently making. And I say, why would you want to do that? Because when you retire, don't you want to do something?
Right.
Those are the years, you've worked hard, the kids are all out of school, don't you want to do things? But that's what that's kind of the rule of thumb is where do you want to be at? So if you make $100,000 a year, what's your current tax rate? Okay. And if you go to 80, how much does that really impact what your tax rate is? So what you have to do is how much is your Social Security going to be? You factor that in the equation and how much you need to fill that gap and how you're going to pay those in taxes. But what we talked about earlier in our previous conversations is if you were in a 30% tax bracket with all the other stuff you have going on, and you wanted to take $32,000 a year out of your 401k, you really have to withdraw $48,000 to pay the taxes. Okay. So now you're talking about how much money? All right. And how does that impact your savings? And why do 401ks burn out? And this is why is because the burn rate begins to accelerate because as you withdraw assets, the assets don't make as much money. And it just begins to stack up and stack up and stack up.
Got it. So what are some of the ways that people actually can mitigate the tax burden of their 401k or IRA accounts?
Well, there's, they came out with the Roth, which is a good thing, and you can do that. That's certainly one way of doing it, but that's capped.
What's the cap?
I believe it was $6,000 or $7,000 a year. It's not a lot.
It's not like 20,000.
No, it's not. You can withdraw some money out of your traditional accounts to convert to Roths, but the bottom line is that's one way. And the other way is start looking at what you're currently contributing into a 401k. And depends on where you are and what kind of income you have. But, traditionally people want to put 10%, of their money away every month. And how much is that? If you make $100,000 a year, well, that's $10,000.
Right.
Okay. So why don't you take, and a lot of the companies will offer you, some match to it. I don't know, when you were at the bank, how much did they match for you?
Oh, I think up to $5,000 if I'm not wrong.
Yeah. Okay. So you start looking at where the caps are, what they match, and you start saying, okay, where do I hit my match point and where can I diversify the rest of those funds? Because when do you want to be paying taxes? Sudev, is the real question. You want to be paying taxes now or do you want to pay taxes in retirement? And that's the question you have to ask because you really don't want to be paying taxes in retirement. You really rather pay them while you're working. So if you took some of that let's say it's $5,000 and you diverted it and paid the taxes on it, which I don't know, whatever your tax bracket, it might be a nominal amount of money, but you paid the taxes on it and you put it into what we call these life insurance retirement plans. Okay. And you get a lot of things out of that, but that's how you start to figure out how much can I put in these programs or can I put some extra? I don't always tell people I want you to spend more money on this. I want you to look at what you're currently spending and see how we can begin to diversify some of that money so that you will have this tax-free retirement money in the future. And a lot of people go, well, how can that be? There's actually IRS rules around this. It's 1101,
Right.
101A, and 72E. And 401k is a IRS tax code. I don't know if you know that or not, but it's an actual, that's where it came from.
That's why it's called
The 401k. It is an actual IRS tax code.
Okay.
Okay. And what it says is this, that if you buy a certain amount of insurance, you have to buy X amount of life insurance.
Is it term or is it?
No, it's an actual life insurance.
Okay.
It's not term. It's for the whole time you have it. And the excess that goes into that can grow tax-free during the period that you have it. And at any point in the future, you can withdraw it tax-free through borrowing off of the policies. Okay. And, people sometimes don't have a hard time grasping it, but when you sit down and look at it, how it works, and we have the models and we show you how it works, it's really amazing. But two things happen there. One is you're growing money tax-free. And the other side of it is, and we'll talk about a little bit more about it, is the money that grows is not subject to market volatility. Okay?
So you have the upside,
but you never have the downside.
Okay.
Did you lose 30% about 2 years ago in your 401k?
Well,
Yeah. Well, I can tell you the dates. It was between December of 2021 to June of 2022. You lost about 30%. Okay.
So we gained it back, but that's different.
Yeah, but what's the recovery rate?
Right.
Okay. And so you take yourself out of those, but then you also get some additional benefits from it. So I don't want to get you off track on your questions. But that's what this does is the insurance. And here's where the problem for the industry is people are just trying to think you're just trying to sell insurance. I don't want to sell. The insurance is the vehicle.
Yeah, you're just educating people.
Yes.
So that,
and you can buy all we ask you to do is at least you have to buy a minimum amount of insurance. And it's different for whatever age you are. So if you're age 50, they're not going to make you buy as much insurance as your age, right. Like your son is, they're going to make you buy different insurance. Now, there are different costs to that, but they don't make you buy as much. Okay.
Got it. So, David McKnight in the book that you're holding, he says, there's a concept of the perfect tax storm. Can you elaborate on that?
The perfect what now?
Tax storm.
Tax storm.
The tax STORM storm.
Oh, the perfect tax storm. Yeah. Well, here's what's coming for us, and what you have to understand is this: our government is currently $36 trillion in debt. Okay, $36 trillion. The interest that we're paying on this is almost now $1 trillion.
Wow.
A year.
1/3.
Okay. 1 trillion, almost $1 trillion just to service $36 trillion in debt. So you see where this tax storm was coming?
Right.
How are we going to pay for that in the future? Okay. And, the bottom line is this is the storm that's coming. And you have to understand that where are they going to be able to find this money? All right. Well, there's an awful lot of money in 401ks.
Right.
And when you go to retire, is the tax rate really going to be 36% or 30%? What is it really going to be to pay this enormous trend? Jay, and there's something else that in this that you have to understand. Do you understand what the unfunded liabilities of the federal government are?
No.
Okay. The low end estimate is 70 trillion.
70
trillion.
Those are not funded.
The unfunded liabilities. Okay. Between Social Security, Medicare. And do you know that the government took over all of the pension funds that were, that people couldn't pay? They took over the liability for those. A lot of these pension funds. Do you realize that pension funds, the only place you can get a pension now is a state government? I don't know. There might be one. I don't know of a single one that isn't underfunded. Not a single pension fund that a state and federal levels are underfunded. So add 70 trillion to 36 trillion. Do you see the storm?
Yeah.
Okay. And do you know what last year's deficit was for the government?
No.
It was $1.87 trillion.
Last year alone.
Last year. Okay. Last year.
Under the Biden
Under the Biden administration, it was $1.87 trillion. Because of my mortgage I have a subscription to a mortgage guy that tells me every 2 weeks how much money the government's borrowing. And it's where average is about $150 billion. I'm hoping that's going to slow down here soon, but that's what we're talking about in a tax storm. Do you see the storm coming?
Yeah, absolutely. So how can people avoid this financial through ILIRP?
Yeah, this is one of the vehicles you can use, and what's great about it is that in addition to the benefits that you get from being able to save tax free, the insurance has its own benefits. All of them are tax free. Okay, if you die, and whatever is in, and I don't want you to die,
Of course.
but if you were to pass away,
Yeah.
and you have, I don't know how much you have in your 401ks, I really don't, and we can have this conversation, but if your family were to get it, all that money's taxable to them. Okay, if you pass away with the life insurance policy that's inside of this,
It's free.
it's totally tax free.
Mm.
Okay, remember the story I told you about his family? They're going to get $50 million tax free.
Wow.
Okay, and this is what's truly significant about the difference in these. And how do you want to leave your money to your family? How do you want to help mitigate these things for your family?
So what are some of the vehicles, other than the LIRP?
Well, that is the best vehicle that we have. And I will tell people, that once again, you have the other tax-free types of things, such as the Roth and some other things to move it into. But everything else you move your money into outside of that has some taxable implications. I mean, if you have a CD at the bank and they're paying you 5% and you have $100,000, and at the end of the year, they give you $5,000. Well, how much of that really is what's taxable of that? Okay. So this is the best vehicle that we have. There are other vehicles that can help you withdraw money first in, first out, a last out kind of situation through annuities and other things that can help mitigate some of that into the future. But this is the best vehicle. And for people to be able to save, there is a downside to it, is you do have to qualify for it.
Right.
It's not something you can actually sell somebody. You have to qualify for this.
What is the qualification?
Well, you need to be a little healthy. Okay. They're going to mitigate the amount of insurance you have to buy is going to be based off of your health. Okay. Now you can still get life insurance even if you have problems. It's just going to cost more.
A little bit more. Okay.
Yes.
So can you break that down a little bit more for us, the LIRP?
The life insurance retirement plan. Okay. The LIRP basically allows you to put money into a what we call this LIRP, and you are able to put this money into this in what we call indexing funds. Are you familiar with indexing?
Yeah.
Okay.
S&P.
S&P, you can use any of it. There are many different indexes. You can use the Putnam, you can use the NASDAQ.
Right.
So the money is put in there. All the excess that goes into after the cost of insurance goes to it, all the excess goes into these different indexing funds. And they can have caps on them. They can have no caps on them. It just depends on how you do it. And what's beautiful about it is every year you reset these things. Okay. So if you think the market's like this past year, the market's on gangbusters. Last 12 months, I don't know what it's up, maybe 30, 40%.
Yeah.
Okay. And you can actually capture up to 35% of that inside of a LIRP. Okay. Because the insurance company will let you be into this fund. They're going to take some money off the top. You're not going to get all of it, but you can get most of it.
That's management fee?
Yes, that's kind of a management fee, their cost. Okay, their management fee for it.
And I can choose the fund that I want to get.
You can choose any of the funds. You can have an 80% participation rate of it. They give you could have a 12 or 14% cap. You can use a 9% cap. Depends on how you want to structure these things. What we do know is that the difference between let's say we all know that if you go back 20 years, it's averaged 6 to 9%. The LIRP also averages 6 to 9%. But here's the difference, is the LIRP never took a single downturn. So when the market went down and your $100,000 in your 401k went down 70,000, the LIRP, the LIRP, the LIRP didn't lose anything. So when the market came back the following year, it started at 100. Yours started at 70,000.
Right.
Okay. So it is actually outperforms that because it never takes the downside, because you're never really invested in the market. It's interest crediting. And people go, well, how do they do that? Well, can I tell you something about insurance companies? All of the insurance companies I use are over 100 years old. How many financial crises have there been in the last 125 years? Okay, quite a few. The insurance companies understand how to mitigate their risk inside of themselves. Even in the 2009 crisis, only one insurance company had a problem. Okay, only one. And the reason for that is they use what you call, they use an indexing platform where they invest part of their money into very safe things and they buy futures options on the rest. They take 95%, invest in these very safe things, and they take the other 5%.
Do they take the risk?
That takes the risk. Well, if the market goes up 20 or 30%, that option will go up with it, and they'll pay you the interest on that. If the market goes down and it collapses, well, the other 95% backfills that 5% that they took on the risk.
Right.
So that's how they manage the indexing. And that's how they're able to keep your money safe. Because recovery rates is all about it. I mean, I know people that it might not necessarily happen to everyone, but I can't tell you the amount of people that I know that in 2001 and 2009 who were ready to retire, they got crushed. Okay, there was no way for them to recover a 30 or 40% loss because they were ready to retire. They just could not do it. They didn't have the time frame. Now, if you're 30 years old, you have time to recover from that. Okay, it will recover itself. And just like your 401k, it is recovered.
Right.
But if you looked at it, well, what if I hadn't lost all that money? Where would it be? Okay, so that's why this program is so significant to people. Is not only do you get the insurance, you get the ability to save and grow your money, and you don't have any downside risk of losing your principal balance inside of it. So those are the real significant things I want people to come away with. And this product has evolved because prior to 2008, they had what they call the VUL. They call these IULs, Index Universal Life Insurance. The VUL was a variable universal life insurance. And everybody thought that was a great idea because the market was going bonkers. Well, when 2009 hit, these variables collapsed and people were having to write checks to keep their insurance alive.
Got it.
Okay. So this product was a hybrid that came out of it. These things have evolved over time.
Got it. So you call this as like a Swiss Army knife?
Yes, it is.
Why? Go ahead.
Well, it's a good question. It is a Swiss Army knife because, hey, you're getting life insurance, and if you die, your family gets whatever you have in there. It's $1 million in their life, right? But what happens if you get sick and you can't work for 4 or 5 years, you're chronically ill? With this insurance policy, will pay you out of that life insurance throughout that 5-year period. And if you ask me why they pick 5 years, well, one or two things are going to happen. You're going to live or you're not during that 5-year period if you're chronically ill. So you can take this, and depending on the size of your policy, you can get anywhere from $5,000 to $20,000 a month, depending on the size of your policy, in tax-free money to take care of yourself. You do not have to go into your taxable assets to take care of yourself. This is one of the other reasons the IRS likes this and the government likes it, is because guess what? They don't want to take care of you either. They don't want to have to anyway.
Right.
Okay. If you were chronically ill, or if you had say you had a stroke. We had a client who only had the policy year, paid $12,000, okay, into the policy, and it was $1 million policy, and he had a stroke. He's a young man. They gave him $108,000 out of that policy to take care of himself and recover. All of that tax-free. He was, individual business person. So that's part of that Swiss Army knife. And everybody, let's say you get terminally ill, which is less than 2 years to live or 2 years to live. You can access up to 90% of the death benefit to take care of yourself during that period of time. And guess what? You don't have to go into your 401k
Got it.
or or any other assets that would be taxable for your family to take care of you. Because that is when you become like that, the amount of money it takes to take care of people becomes really, really high.
Right.
So that's one of the other benefits of it. So now we're talking about not only life insurance, but chronic, any of those kinds of things that could happen to you are all inside of this program.
Got it.
All right. And all of it is tax free and keeps you from having to access
Got it.
the other side.
So the 401k and IRAs typically you cannot touch until you're like 59 and a half.
Well, that's the other part of the Swiss Army knife.
Right.
Okay. Because your money's not in jail until 59 and a half. If let's say you've had your policy for a period of time and you funded it and it has $100,000 and you're 49 years old right now. And Sudev says, well, I really always wanted my dream car, or I wanted to buy a car for $50,000. Okay. You can go in and borrow that money, that $50,000, pay yourself back instead of a bank.
Right.
Okay. And guess what else happens when you borrow that money? Instead of your 100,000 becoming 50,000, it remains at 100,000 and will continue to grow at 100,000. Okay. They're going to charge you, let's say 5% interest on that 50,000. But if you're making 7 to 9, well, you're still on the upside and your asset is still at 100,000, growing at 100,000.
So that's your base is 100,000.
Right.
And then when you take the money out, you're paying yourself
Back.
and then that's lesser than the interest is lesser than the.
Yes. And you're still making 7 to 9% on 100,000 and you're paying your money back. So it begins to accelerate itself. You really can become your own bank and there's no penalty. Your money's not in jail until you're 59 and a half. Even a Roth has that penalty on it. Okay. You cannot access a Roth until you're 59 and a half.
Wow. Interesting. Some of them, they say that it's too expensive and complex. What's your take on it?
Well, they don't know really how it works when they say that. Because how much does it cost you to administer your 401k? Do you know what your expenses are in your 401k? I bet you really don't, but
I don't know, but I guess it's like 2% or something.
Yeah, it's 2%. Okay. So, well, how much is that costing you? Okay. If you make 9%, well, you only really made 7%, didn't you?
Right.
And guess what else? If your 401k dropped 30%, your guy still made his 2%.
Yeah,
or whatever.
he's still making the 2%.
He's still making the 2%.
So that's 32%. Actually.
Yeah. Okay. So, and the other thing that happens is the cost of insurance actually goes down the longer you fund it. Okay. Because the cash value actually becomes part of the insurance policy. So the cost of insurance begins to decrease. So over a 5 or 10-year period, the actual costs go down. But when they say it costs too much, well, what are you paying for long-term health care insurance? Do you have a separate policy for that? Okay. When you talk about cost, what does it really cost? And what are you getting from it? Complexity, it's very simple in one aspect. It gives you several different funds that you can go into. And it depends on how well you understand the market. And I have one client, he loves the S&P. He wants to stay uncapped all the time. Well, the uncapped has a floor of 0. Okay. And it can go up to whatever it is. All right. Whatever that year it is, there's going to be a 4 to 6% that they're going to take off the top, but you're going to capture most of that, but you're never going to lose money inside of it.
Right. So can you just explain to the audience, what does a capped and uncapped mean?
Well, first of all, capped and uncapped, and that's a great question. If you were in an S&P, and let's say the market went up 20%, and we have a cap of 12% that will pay you. And it actually has a floor of 2 to 4%. So it doesn't actually go to 0. It will actually pay you something.
What happens to be 8%?
Well, slow down. Okay. It has a floor to it. Okay. But if the market went up 20%, you would only get 12% of that.
Got it.
Okay.
That's the cap.
That's the cap. If you're fairly conservative and you don't want to get involved in the uncapped. And it has a floor of 2%. If the market collapsed, you would still make 2%. Is all it's saying. It's giving you a different floor. All right. So it just allows you to have that. We have what we call 80% participation, which means you can participate up to 80% of whatever the market does. They have all kinds of different funds inside of these. And it just depends on what your tolerance for risk is. Okay. And we can divide this up in several different ways for you. We could put you in 25% uncapped. We can put you 25% capped. We could put you in 25% fixed rate. You can divide this up any way you want to inside of the policies.
It depends on the risk appetite.
It just depends on your risk appetite going into it. And we can reset these every year for you. You need to have an annual review of your policy. And this is something else that doesn't take place. People sell you a policy and they collect whatever they get for the commission on it at that particular moment. And they never talk to you again. But we go back in and we want to tell you, hey, here's where we are today. This is what you made this past year. Where do you want to be? Let's analyze what the market has done. Okay. If you've just come out of a big boom year, 40 or 50%, I don't know if it's going to do that again this next year. You want to be in something a little safer, because if the market only went up 10% and you were in a uncapped, you might only get 3 or 4% of that. Okay. So it just depends on where you are and where you want to be.
Right. So coming back to the book, The Power of Zero by David McKnight.
And this is a very easy read for everybody. This is not a complicated thing. I really encourage everyone. I give this to my clients to read.
Awesome. Yeah, I know I have one of those. So he talks about 0% tax bracket.
Mm-hmm.
What does that really mean and how realistic is it to achieve that?
Well, here's what you're trying to say. What he's trying to say in this is how do you get to a 0% tax bracket? Okay. And it really depends on how far you are into the system. Okay. But if you know that there's a rule called 72T. Are you familiar with this?
No, I'm not.
Okay. What it allows you to do is you can actually access an IRA a certain amount of money every year and not pay the penalty.
After the 59.5 or?
No, before. You have to do it on a 5 to 10 year schedule, and you can begin to diversify. And there's a scale in there. We have a calculator that'll tell you how much you can take out every year without any penalty. You have to pay the regular tax on it, but you will not pay the 10% penalty on it. And you can start to diversify this money into these other programs like the LIRP and begin to mitigate some of your tax, into the future. Because when do you want to pay taxes? You realize that retired people, one of the number one expenses they have is taxes. And then it's healthcare. Okay. How much of that do you want to pay? You have a certain amount of money every year. I think this year it's like 20. If you're married, it's like about $29,000. It's your first $29,000 you make is not taxed. Okay. I think for single, it's about 15 or 16. I'm not right on these numbers, but that's what you have. Okay. You start to ask yourself, okay, how much is your Social Security going to be? All of those things. You realize that when you hit over 44,000 as a married couple, you start to have to pay taxes on your Social Security. Now, I know our current administration would like to make Social Security tax free. I hope he can get that done, but you can pay up to 85% of your Social Security can be taxed. Okay, so why is this important? Because all the money that comes out of these policies borrowed does not count towards any income. All the money you withdraw from your 401k is counted as income. All right, so how does that impact the taxes as you go up the scale? Can you truly get to zero? Maybe not, but if you can get as close to it as you can, that's the plan. He uses a real interesting word. It's a 4-letter word in here. It's called math. And you really just need to sit down and do the math of where you are and where you want to be. Because that's what mitigating the future of taxes. Pay the taxes now while you're working. And you might think, well, why do I want to do that? But if you have to pay $2.50, $3 for every dollar you save, why would you want to do that?
Right. Got it. So what are some of the practical ways for people to actually move from or transition from the retirement savings to the tax-free vehicles?
Well, I just mentioned one, using the 72T, being able to do that. A lot of people have left companies and they have IRAs. And And depending on your timelines and where you are in life, we have programs where you can move those funds into annuities, and it allows you to use that same program, but it takes you out of the market volatility and allows you to grow under the same indexing programs. Okay. That's one strategy. The other strategy is we actually, after 5 to 7 years, we can go back in and show you how to use this money twice to buy other policies. Okay. And begin to stack these policies to begin, once again, all the money you withdraw out of these under borrowing it under the correct way is all tax-free.
So there's this concept of Roth conversion, right?
Right. And this is like a Roth conversion.
Okay.
This is very similar to a Roth conversion. And the other thing that's really great about this program is there's no caps on what you can put in it. Okay. You can put as much in there as whatever insurance you want to buy. You can fund it as large as you want. If you, Sudev, wanted to put $50,000 a year, because I know you're going to have a great year, and you wanted to put $50,000 away and have your business pay this for you, you could do that. Okay. You could put $50,000 away, and your money would be available to you if you needed it.
Right.
If you you have access to it without any penalty. So that's kind of what the conversions are, is this start, you can use this as a Roth conversion. You could start using the Roth conversion under the 72T program.
Are there some income levels or financial situations where this can happen? Or it makes sense, Roth conversions?
Well, obviously the more money you make, the better off you're using this program.
Right.
And those are always things that you have to take into consideration. But I don't think everybody is eligible for it. It's just that where are you at and what your goals
Your goals are. Okay. How does having multiple tax-free income strategies actually helps in the retirements and especially during uncertain economic times?
How does having multiple ones?
Yeah, multiple tax-free income strategies.
Well, first of all, almost all of our income tax-free strategies are all in index programs. So, okay. So when you put indexing into the equation, it takes out the volatility of the market for you to suffer any huge losses. Are we going to face a market correction at some point? It's not a question of if, it's just a question of when. Okay.
Yeah.
And the more money you can position out of that into this. And the other thing about these policies is, let's say your premium is $24,000 a year. Well, it actually has up to 36, in some cases, 36 to 40,000. You can actually put in it above the 24,000, and you can fund these higher. But let's say Sudev has a bad year and he can't do 24,000. And it has a floor of maybe 12,000 that you would only have to put in. And in some cases, you can actually use the cash value inside of the policy,
Right.
keep funding it if you couldn't do it at all. So when you talk about that Swiss Army knife, look at all that stuff inside of that. These things have got so much versatility inside of them that you can fund it as much up to a certain level, and you can go down to a level if you don't want to fund it that year, and you can catch it back up in the next year if you want to. So there's all this flexibility inside of the program, but using it for multiple is you can have as many of these policies as you want. There's no cap on that.
Mm-hmm.
What one of the books I've read basically says what we want to do is structure these programs to be, you want to fully fund them in 5 to 7 years. Okay. And start stacking these programs as you go further and further. The other side of the versatility of it is you actually can set this to where your life insurance, without costing you any more money, grows over time. Let's say you had a $500,000 policy. After 10 years, that policy would potentially have $600,000, okay, in death benefit for you or other benefits. So they're set to do different things, and you didn't have to qualify for any more insurance at that point.
Cool. So someone like me, let's say if I start my retirement planning later in life, is it kind of too late to implement these kind of strategies?
No, it's never too late, okay, to do anything like these. if you were 60 right now and you wanted to start one of these programs, well, instead of you having to buy $3 million worth of insurance, you might only have to buy $500,000 worth of insurance, okay, to qualify for it. And then you can start moving your money while you're still working, because you're outside of that 59.5 penalty. You can start moving more of your funds into it. And yes, you'll pay the taxes on it. But when you hit that level that you want to be at, when you want to retire, whether it's 67, 68, whatever that case may be. And the other side about this is you realize that you have a 401k. At some point, they're called RMDs. You know what that is? It's a required minimum distribution.
Right.
And right now it's 73. And you were required to take money out of that policy and pay the taxes on it. And if you don't, there's a huge penalty for it. So that also begins to mitigate the RMD side of this, because if you didn't want to take the money, you don't have to.
Okay. So what are some of the misconceptions about the retirement tax planning?
The misconceptions of it? Well, what you mentioned, one of them earlier, the cost of it, the complexity of it, okay?
And the timeline.
And the timeline, okay? Here's the thing, is you need to sit down and with, someone like myself, and I work with a group of people, we want to sell you exactly the amount of insurance you need, not a target premium. A lot of agents sell the target premium where they make the most money. You may not need that much insurance. Okay. We can scale this back to a lower insurance policy and be able to reduce the amount and maximize your cash value side of it.
Right.
And that's what you want to do. And then, we start looking at, okay, well, if you did a little bit more insurance, how much does it affect your cash value? We look at it 5 years and 10 years down the road. How much, if you bought a little more insurance, how much insurance do you need? And what are your goals inside of it?
Got it.
You don't want to always sit there with one of these policies. That's what the problem is people trying to just make money off of it. The reason, and I'm not, if you have a financial planner, and a lot of people do, they tell you, oh, it costs too much and all these other things. Well, I'm glad you have a financial planner, and it's a good thing to have somebody handling your money. But what they don't understand is that, there's a piece of this that has so many other benefits inside of it. And one of them is long-term health care. I mean, let's face it, if you just buy an independent long-term care policy and you die before you ever use it, well, what happens to that? Right. Sometimes they'll refund the premium, some of them have, but there's nothing to that. This gives you the ability to replace these things.
And still tax-free.
And it's still tax-free.
So if someone were to listen to our, to what you're talking, and if they want to start their journey towards tax-free retirement, what's some of the first action steps that they need to take to start their journey towards tax-free retirement?
Well, here's the first thing I tell everybody to do is go to SSA.gov.
SSA?
SSA, Social Security Administration.gov, and set up and get your account set up. It will tell you everything you've paid into the system and what your projected Social Security would be. Okay, in the future, whatever that timeline date is. Now, that's a moving target.
Right.
And unfortunately, we've been hearing that they may have to cut these benefits by 20% in the year 2033 to 2035. So you got to start factoring. But that's the first step, is knowing where you are. Okay.
And how much you're going to get.
Yes. How much you're going to get there. That's the first step, is understanding because that's going to be hopefully 30% of whatever your retirement will be. Okay. All right. There's the first step. All right. Second step is what do you currently have and what did you put away? And what are the projections on that going forward? With the rule of 72 is correct.
Yeah.
Okay. If you take whatever money you have and divide it by the interest rate, that's 8%. It's 9 years.
Yeah,
9 years. Your money's going to double.
Yeah.
Okay. You just kind of project out where you're going to be at that point, and you can kind of get an idea. And then you start to determine, well, how much do I want to have? These are the conversations you need to sit down. And I'm going to tell you something. You've never had that conversation, I'm willing to bet. of where you are. What do you have? You need to sit down and say, what do I have? Where do I want to be at age 65 or 67 or 60? If you told me you want to retire at 60, okay, how do we get you there? Where are the gaps in what you're doing right now? How can we move what you're currently spending? Because I tell people all the time, if you have some extra money to put in it, that's great. But let's look at what you're currently doing and see where we can move this money. If you were age 55 and you had an IRA and or 401k that I don't know how, we all know people that have several of them. They've had to roll them into an IRA. They have 401ks that they haven't even moved yet. They're still with the old companies. Why, I don't know, but they still are.
Right.
How do we mitigate the risk inside of that? Because you've already built the tax implication inside of it. You already know where it is. Well, how do we mitigate that risk for you? Okay, we start looking at programs that can help, protect your money, mitigate the risk, and be able to do asset conversion inside of it.
Great. So, Ronnie, you have shared so much information today. And, how can people know more about this, and how can we get actually in touch with you?
Well, first of all, you can reach me. I have my phone number, obviously, 704-562-6194. I have a Facebook page, Ronnie Giberson. I have Giberson. But really, more importantly, as I really tell everybody, please read this book.
Yeah.
I've read extensive books of how to structure these programs for people.
Right.
It's not just about, hey, I read this book and I'm an expert at it. I'm not. I had to really in-depth read all of these things.
So then study or live. It's not just read it, study.
Study how to structure these people into the right indexing funds,
Right.
how to review them every year with them and make sure we're getting them to where they want to be on their goals. Okay. But more importantly, I really emphasize this because I really have been on a mission to try to teach people. I see people 55 and 60 years old still pouring all this money in 401ks.
Right.
Stop. Okay, just stop and reassess what you're doing, because all you're doing is building this up and building this up.
Right.
There's a reason the average 401k burns out in 13 years. The number one thing that stresses people out is running out of money when they retire.
Oh, yeah, absolutely.
How do we do this? Do you realize that, and I talked to you about this earlier before we started this, that you can only take out 4% a year out of a 401k or IRA and have it last until you potentially pass away. Well, if you had $2 million in there, I would be mad if I could only take $80,000 a year and then still had to pay taxes on top of it.
Yeah.
And still net maybe 60,000 or whatever that number is.
Right.
I think those are the kinds of things that I really want to get across to people. Financial planners and all those people, I think they're all good. Don't have any issues with them, but you have to start looking at all of the things that you can do. And one of them is how do you mitigate taxes? Because I don't care what you say, as he talks about, this book was rewritten in 2015 or 16. You know what our national debt was when he read this? It was $15 trillion.
Today it's about 100.
Huh?
About 100? $100 trillion?
And today it's 36 trillion.
36 trillion. Okay.
If you add the 70 trillion in unfunded,
that's what I was thinking.
you're at 100 trillion. But our national debt's at 36. Look how much it's grown.
Yeah.
And as much as we all want to do is think that all these things are going to happen, people are going to end up paying more in taxes. And it could go to 50% or 60%. Where do you want to be in retirement? How much of your money can you get out of this trap and into this as possible to help mitigate your future tax liability? Because we all want to be able to do things with, grandkids, and people don't even think about this. When you sit down with financial planners and people, they say, well, how much are you spending on your mortgage and this, that, and but they'll ask you, how much do you spend on your grandkids? No one even thinks about that, but you spend a lot of money. If people spend money on
absolutely, yeah.
How are you going to be able to do all those things? How are you going to take those trips with them?
Yeah.
You want to think about all those things. And, from 65 to 85, 70 to 85, we call them the go years. Okay. After 85, you might slow down just a little bit.
Right.
You might want to not go as much, But we try to tell people, think about what you want to do up until that point. How much money do you want to have? And it's all a process of sitting down and talking about where you are and what you have. If I did nothing else but teach people today, that would be, I would be ecstatic. Okay. Do I want you to come and talk to me? Of course I do. But I really just want people to know
No.
what is happening. We've been misled in teaching how we've been taught to save all these years and how to help mitigate that problem going into the future. How do you protect your family? There's a death benefit to this. So if you die, you leave your family tax-free money,
Right.
But if you live, hey, you get to use this money. It's not all just about insurance.
Right.
So we want to teach you both of those things. And like I told you the story before, you, Sudev, can do the same thing. Every individual business person can save money using this tax-free. You can take money out of your business, fund these policies, and it's a tax deduction, and be able to access that money in the future,
Right.
tax-free, whichever way you want to do it. So that's my conclusion of this is sit down and ask yourself. It's just like I'm having a seminar this weekend I've told you about.
Yeah.
On budgeting. People don't even budget correctly. How do you budget your future? And this is what it's about, So, and I really appreciate it. I hope I wasn't too confusing with any of this.
No. We have some more questions later. It's fine.
We have some more questions. Yeah, let's go.
So these are rapid fire questions.
Okay.
And feel free to take your time to answer.
Sure.
There is no time limit to all of that. So what's the biggest myth about retirement savings?
The biggest myth about retirement savings is that you're going to not pay taxes in retirement. I'm just telling you right now, and do you know how many people don't know that you have to pay taxes on your 401k? You would be amazed.
Wow,
Okay.
That's a myth.
That is a myth.
Cool. 401k or Roth IRA, which one do you prefer?
Obviously I think the Roth is the better of the two, but the Roth is limited. Okay. Here's what I also tell people. What's the match at your company? Okay. Take the match.
Yeah.
It's free money. Take that match. So that's how the strategy, but don't do any more than that.
Got it. Okay. So what's the worst mistake that people make with their 401k?
The worst mistake that they make with it, putting too much in it. I mean, thinking that that's going to carry them throughout their retirement.
Yeah.
And not understanding the tax implications. And he does this in the book. Okay. If you wanted to net $100,000 out of your 401k every year, you'd have to take out $144,000 out of it to be able to net the 100 back. Yes, because you're going to pay 40. Think about that. That's almost 50% of what you want to net.
Yeah, absolutely. Yeah.
And that is something that you really don't understand about it. And the other side of this is that the 401k, once you start to take money out of it, your investment is no longer making the same amount of money. All right. So that's one.
Cool. So that book, Power of Zero, what does David McKnight really mean, the power of zero?
The power of zero is how could zero be your hero in tax-free retirement? Okay. That's what I came up with, but I don't know if I coined that or not. But what he's talking about is how can you get as much as your money, the power of zero. The power of zero in retirement is huge because the less money you pay in retirement is the more money. But also you got to remember all this money that you're taking out that you're borrowing out of this policy does not count to any of your benefits.
Right.
And that's real key because if you make too much money and your Medicare could go from I think it's $185 a month to $500 a month very quickly. Okay. And, the thresholds to that, we all hope to be maybe in that threshold, but you're trying to help reduce that because it all affects your benefits in the future. You realize that if you wanted the government to take care of you, you'd have to burn all of your other money would have to be burned out completely. Okay.
Makes sense. So what's one financial strategy that you wish people knew more about?
this is it. This is the one financial strategy that I wish people had understood 20 years ago is what is the 401k really doing for you, and where is it going, and how is it, what is the tax implication of it? Let me tell you something. What the 401k created in this country was a lot of people were told this is the way to save, put your money. Do you know what Fidelity or whoever it is that's do you have any idea what they invest in? You have no idea what they do with it every year. You just go put your money in there, and these funds, they're functioning. Well, what did these Wall Street get? They got millions of unsophisticated investors pouring millions, billions and billions of dollars every year into the stock market, And I think people really didn't understand, well, how is this all being managed, and what is it really costing me?
So tax rate, are they going up or staying the same?
Well, I think, and you have to understand the current state of politics, that right now they're trying to keep these current tax rates where they are because they expired at the end of this year. And if they don't pass it, the impact is going to be big on everyone, because in this book, it shows you the difference inside of the tax brackets, where we currently are and where we were before. And where you go in those tax brackets, and when those tax brackets begin to kick in. So do I think, but I don't see taxes going down just because of the state of our debts, what we owe. If we could get to a balanced budget, okay, think about it, just a balanced budget where we don't borrow anybody, okay,
That'd be awesome.
That would be awesome. But when you think about $20 trillion in debt have been added in 10 years. $20 trillion of debt has been added in the last one. It's unsustainable. And at some point, it's not going to work. And how is that going to impact your Social Security? I thank everybody, and a lot of people don't realize how old I am, but I thank you all for contributing into. Do you realize there's 1 in 2.6 people, for every one person drawing it, there's 2.6 people getting, paying into the system.
Yeah. That's totally unbalanced.
Yeah. Well, I just hope one of mine doesn't die. Okay. But seriously, that's where we were when the system was first created. It was 1 in 42,
So if tax rates were to double, what would happen to the 401k balance?
Well, the 401k balance, let's say you wanted that same $100,000. Well, you'd have to take out $200,000 to get that same 100,000.
Wow. And what's your favorite tax-free building tool? Is the LIRP?
It is the LIRP, is the IUL, Indexed Universal Life Insurance Policy. But try to understand, you have to understand it, and you have to be educated on it and how it functions.
Is it overrated or underrated?
I think it's underrated because a lot of people don't know about it. And I think it's also vilified by a lot of people because they don't understand it. As I told you earlier, and I know you want to share some things with me, financial planners are great at accumulation, but they're not really good. They're terrible at the distribution side of it. And, so when you start looking at those things from a distribution standpoint, where are you?
Got it. What's the biggest advantage of a LIRP?
I think the biggest advantage is all the tax. Well, not only that, it's all the things it does inside of it for you. Mm-hmm. You get long-term care, you get chronic care, you get terminal care before you die. And then there's also the death benefit. Mm-hmm. All right. So you have all of those things that come with it. And you have the ability that your money is not in jail. Your money is not in jail.
It's liquid.
Yes, it's a liquid asset. It truly is. And it's not subject to any penalties. Oh. And the other side of this is, remember, when you borrow against a 401k, and this is really important, that money is taken out of the pool. Okay, you may be paying it back, but that money's taken out of your pool. When you borrow from this life insurance policy, that money's not taken out of your
pool. The core is still there.
The core is still there. Mm-hmm. You might be paying them 5%, but if you're making 7 to 9%, well, there's an arbitrage there that you're making. You're making the 2 and 3% above it. Okay. And you're only paying the interest on whatever you borrowed. So at 100,000, you're still making money on the 100,000. You might be paying the interest on the 50, but you're still making the money. So Those are the kinds of things that you really have to understand. Once again, you get back to that Swiss Army knife. Did you realize it does all that?
Yeah.
When we started this conversation, you did not,
We're done.
you know? And so when you say, well, it's too expensive, well, how expensive it is to have all the other things inside of this, that you're talking about. And those expenses go down over time.
Cool. So how can LIRP protect against market crashes?
Well, first of all, when market crashes, your money, your value, their 100,000 that we talked about is not intact.
Okay.
So if the market goes down 40%, you're still at 100,000.
So there's a floor.
You lose no principal balance when the market cap.
Okay.
Whatever your principal balance is at the time of that crash remains safe inside of there. And when the market comes back the next year, you may have made zero that year, but you're going to be making 10, 12, 20%, depending on how you put your index in there. I would tell anybody after a big market crash, when your policy comes around, throw it into the uncapped because you know it's going to come back 25 or 30%. And you're going to be able to pick up all of that gain inside it. The examples we give people when we show them how their money grows, we use very conservative. We use like 6.25%.
Right.
We know that's it's going to do better than that, but we use very, very conservative ways of showing. We do not overestimate what these things can do. But this is the very least it will do for you. And here's and when you start thinking about this, and if you add more money, it's like putting steroids into it because it's not buying more insurance. It's just going into the cash value side of it.
So if someone has $1 million in IRA, what should they be doing today?
Well, I would have to tell you, it depends on how old you are. Okay. If you are 50 years old, I would take and use the 72T and figure out how much of that $1 million you can take out every year to move over into this program.
Yeah.
Okay. Tax free. Okay. If you're above 55, I would tell you to try and to mitigate market volatility. You're at a point 55, 60 years old. You don't want to be in market volatility. And you need to start looking at potential. There are some great annuities. Annuities are another thing that's got a bad name. We have an annuity out there that has an actual index inside of it that right now is based off of anything that's done in the United States. In other words, if it's bringing anything manufacturing or anything like that, what do you think that's going to do over the next 4 years? That particular index fund under the current situation we're in. Okay. It has one of those funds in it, but it has all these indexing funds inside of it. And the problem with annuities, these people sell it to them and they put them in some 3% or 4%. Of course, they're not going to perform. But if you put them in one of these indexings, then what happens is the annuity will pay to fund. You can do the same 72T. It will pay to fund it. And at the end of 10 years, you will actually have this almost the same amount of money in the annuity as you did when you were funding out the other side of it,
So what's your favorite chapter in The Power of Zero?
My favorite chapter, I'd have to open the book up. I apologize. Because I did favorite chapter, but for me, and I'm going to fumble around here for a second. It was, I apologize. You give me with a tough question there. The tax-free bucket and the tax sale of a lifetime. Those are my two favorites in there. I needed to look in there. Understanding those things, how to move your money from these tax-free buckets. We teach people all this time. We have a great slide that we use in one of our presentations, and we show two brothers that started this at the same time.
Right.
One went into the LIRP and one went into his 401k. And the brother that had the LIRP actually had less money cash accumulation than the IRA.
The distribution was right.
But the distribution went to age 95 and the 401k for the same $32,000 they were going to net out of it. One would go to 95 and one would only go to 78. And to be able to fund this one to do the same thing that the LIRP did, you'd have to have $500,000 more in it.
Oh, wow.
To make it perform the same way this.
So there's always that imbalance.
Yeah, you think, oh, well, this is not any good because it doesn't have as much. But you're not looking at the fact that when you start to take money out of it, you're not losing your investment
Mm.
rate of return, you know.
So, what's a Roth conversion ladder, according to you, in one sentence?
A Roth conversion ladder. That's a good question. I'm not sure I can answer it correctly, but basically you're taking your Roth and you're laddering up every year. You're doing another one and another one and another one. Okay. That's a Roth. That's what the LIRP does. And so to me, that's the Roth conversion is laddering up every year, a new one and a new one and a new one. And that's what we call laddering is
Right.
more of these that you can create, the more of that
One top of the other.
one top of the exactly. That's what you would refer to as the laddering part.
So, is it ever too late to start to move to a tax-free strategy?
I don't think it's ever too late. It can become, like when you reach the age of 70, you could still do this. It just becomes your cost strategies become different inside of it. Okay. The main thing when you get to this age is how do you, if you have a lot of assets and you want to leave them to your family, this can help you mitigate the taxes that those people are going to pay. And that's where that strategy, the strategy begins to change to asset protection and creating tax liabilities for your family, because that's the biggest thing is when you leave your family something, what are they going to pay on it? And the 401ks are all taxable to the family. You might have to pay it out over a 5-year period, but it's still taxable to them. And on top of that, it can push them into a different tax bracket. So, those are all the dangers inside of that is when you leave that to them that way, let's say they're making 100,000 and they have to take out 50,000 of it every year. Well, now they're in a $150,000 tax bracket instead of the 100. What's the tax implication of that to the family?
Yeah. So, what's your best one-liner about retirement tax planning?
My best one-liner? I think I gave it to you earlier.
What was that?
Well, zero is your hero in tax.
Zero is your hero.
In tax-free retirement planning. I mean, it really is. When you start looking at that, how do I get to that, and where do I go to get to it? So, it's sort of a moniker that we all created to kind and exemplify what we're trying to get across to people. Everybody thinks zero is a bad number, but it's not.
It was invented by an Indian.
Yeah. What, zero? How? Oh yeah.
Wow. It's by a guy called Aryabhatta.
Well, you just taught me something I did not know, but and also zero can be your hero inside of these programs, because if you just made zero when the market crashed, that's a good thing. If you lost 30%, that's not a good thing. Right. That's where it also becomes your hero. Is protecting principal balance. I can show people the scales of the index funds and they outperform the S&P only because they never take the crash. And these are just capped 12% capped ones. If you became more aggressive, it would be far more than that.
Okay. So one final question. If you were to give one piece of financial advice to someone like Aryan, in 10 words or less, what would that be?
Start now. I think, look at you, because the cost of his insurance now is negligible. And the more you start to do this now, the more you're going to have in the future. I'm going to tell you something. If you have a grandbaby or a child, you can actually start one of these. As soon as they get a Social Security number.
Oh, wow.
Okay. Yes. The only thing that you can't do is insure the child for more than your own personal insurance.
Oh.
So you could give your baby a $500,000 life insurance policy at the time of birth and put this money to him. By the time he's 21, he will have, there's no telling, depending on how you fund it, you will have possibly $200,000 in tax-free money to be able to fund his college or do whatever business he wanted to do, buy a house. There would be so many things that you could do. So it really does scale up, but you just need to start saying, I put my son in this. I got my daughter one, start now. Do not wait. We'd made a joke about housing because I've been in that side of it. When was the best time to buy a house? Well, it was 5 years ago. But, the truth is now is the time. I will tell anybody this: the longer you wait, the more it costs. Okay,
Makes sense.
It really is. It's the more it will cost you, and and I tell people all the time, my life isn't going to be any different if you don't do this. It won't, but yours potentially will, because you're going to end up paying more for your out of that 401k in taxes than you want at the time you retire. And I want people to have, if you want to, I don't want to retire. I'll be honest with you. I like doing what I do. I want to phase into different things, but I enjoy working.
Yeah.
It keeps your mind, but some people want to, they want to go play golf or whatever it is they want to do. Whatever your goals are, make sure you got it planned correctly.
Makes sense. Ronnie, it's been a pleasure once again.
Oh, thank you. I hope I got the message across correctly. I really do. I try it. Like I said, this really simplifies things for people.
Great conversation, and look forward to having many more.
Yeah, me too.
Hey, what a great show with Ronnie. I mean, I absolutely loved it. I'm sure you loved it too. He went into the in-depth of LIRP, life insurance retirement plan, and a bunch of other concepts. If I would highly recommend that you watch out for his third episode, which is going to happen very soon. um, you know I'm sure you enjoyed it. If you liked it, give your comments, and if you have any questions, reach out to us through this channel. We would love to hear from you. And if you're planning to take some life insurance retirement plans, make sure you reach out to Ronnie. He's going to help you out with the best thing that is out there for you. Have a good one.